All right, let's talk about 6 ways you can make your monthly house payment lower if you bought in the market right now. I'm Sam, and thanks for coming by the Living in Tampa channel, where we make videos about what it's like to live, move, and invest in the Tampa area. So I want to share a story that I'm actually kind of processing myself. So we live here in the Tampa area, and my wife wants to move to a different part of the Tampa area. She wants a little more space. She wants like an acre or two. That kind of thing is common here. There's a lot of space here. People don't realize there's a lot of land in Florida. And she just kind of wants that tucked away homeschool vibe. It's great. It's fun. I grew up like that, so that seems really fun to me. But it's challenging. It's really challenging in a market like this, where we have such a low interest rate on our current house. To sell that and then buy another place at a way higher interest rate feels a little bit overwhelming. And if we wait for prices to come down on our purchase, we're also sacrificing some of that equity that we have in our house right now. You can't time the market entirely. If you do, it's just kind of lucky. But I want to talk about a couple things we could consider to actually lower our monthly payment on the next place. Number one, basic, everybody should do this, is insurance. Insurance is, part of your principal, interest, taxes, and insurance payment every single month to your mortgage servicer. You should always shop around for this. You saw my video about my insurance going up. Just by shopping around, I was able to make it not go up as much. It still went up. But shopping around for your insurance, asking the questions of what could I do, how could I adjust my coverage to make this a little bit cheaper, those kind of questions will get you a long way. One cost I had with shopping around for my insurance is I had to get a new 4-point inspection. And this is a thing for older homes in the Florida area. A 4-point inspection is like you actually pay an inspector $100 to come out and check like the 4 main mechanicals of the house. So they check the roof, electrical system, plumbing, and HVAC, I guess. Yeah, so they're just making sure those 4 systems are all operating, don't have major deficiencies, they aren't super old. That kind of information is what the insurance company needs. Okay, the second way is to try to get your taxes cheaper. So I didn't quite know about this process until somebody started asking me. They were moving from Illinois, and Illinois has very high property taxes, but they go every year and they argue for a lower assessed value on their property. Now, if you're staying in a house for a long time, this would make sense. If you're wanting to sell your house, you don't want that assessed value to go lower because that's gonna affect your comps and that's gonna affect what the house sells for. Theoretically, it doesn't always affect it so directly. But you can approach the county and you can present comparable sales and show, hey, you're overvaluing my house, or you're overvaluing this part of my land, or you're overvaluing the addition of the pool. It didn't cost me that much to put it in. Those kind of things. Another way to reduce your taxes is in Florida, the Homestead exemption. So what this does is it just caps how fast your taxes can grow, your assessed value can grow on your property. It's not a huge impact on the short run, but in the long run, it is a very big impact. You see houses that pass in families, and sometimes those tax bills jump so fast. So like, for example, a house that is in my wife's family, the matriarch that was living in that home passed away and it went to her sons. So the tax bill before she passed away was $2,500 a year. As soon as she passed away, it jumped to $10,000 a year. So you see some of these like big family properties in like old Florida areas that pass to family, and then the family sometimes just has to sell it because they can't even afford the tax bill. All right, the number 3 way to lower a monthly payment is with an adjustable rate mortgage. And I know there's some nightmares that happened in like the 2007, 8, 9 crash with these, but they can really be used as a tool. And it's something that I would consider if I were moving right now, because right now I've lived in my current house for 2 years. I lived in the previous house for 3 years. Why would I assume that the next house I'm gonna live in for 10 years or 30 years? We always like to think that kind of thing, but the likelihood of me moving in 3 to 5 years is very high. So the way that an adjustable rate mortgage works is it is lower for the first few years. So between 5 and 10 years, and that's not a few, that's quite a bit. As you get closer to 10 years, you can get that rate a little bit lower. And then after 10 years, it goes up to the market rate. But it doesn't just like snap up to that rate. It can only increase by a certain amount every 6 months or every year. And all that is like negotiable with the lender. So it's capped on how quickly it can increase, and it's capped on how high it will increase. And they do go up pretty high. At the max, you're gonna pay, 11, 12%. But it doesn't just go from 5% and 6 months later, it's 11%. And the reason that this is a good tool is because if you sell the house, you're obviously, that mortgage is getting paid off in the sale. Or if you have a chance to refinance, if rates go down a little bit or a lot, you have a chance to refinance and get that rate and payment lower. All right, the fourth thing, this is called a 2-1 buy down or a 3-2-1 buy down. Different lenders call it different things. This is actually pretty similar to an adjustable rate mortgage where you have an introductory interest rate and then it goes up. But those amounts are negotiated in the loan. So say it starts at 4% interest for 2 years, and then after that it goes up to 6% or whatever was decided at the very beginning. It doesn't do it based on the market at the time of that increase. This kind of loan has more what they call points up front, so more expenses to you, closing costs that are paid to your lender for that rate reduction on the front end. And we'll get into like a regular rate buy down next, but this 2-1 buy down cost is quite a bit lower to reduce that rate than like a typical rate buy down. It's a lot more impactful. You know, you're gonna pay 2 points. So on a loan of $400,000, 2 points would be $8,000. And that could reduce it up to 2% of interest, that rate for that first 2 years. All right, next is just a typical rate buy down. So what this means is like it's a typical 30-year mortgage and you're paying money up front to reduce the interest rate for the entire length of the mortgage, that 30 years. So this typically costs 1% for every 1/4% of interest. So let's create an example here. $500,000 loan at 6%. Your monthly payment with no taxes and insurance would be $2,400 on that. And let's say you wanted to buy it down a lot. So you wanted to go from 6% to 3%, and you put in $60,000 of extra cash to do that. Or the builder offered an incentive and let you use that like flex cash like builders have. We'll get to that in a bit. But let's say you bought that down to 3%. That would be reducing that payment from $2,400 to $1,700 per month. Still no taxes and insurance in there. So that's a reduction of $700 per month. That'd be $8,400 less per year. But to break even on that $60,000 that you brought out of pocket, it would take over 7 years. So if you're not living in the house for 7 years, it doesn't make sense to buy the rate down that much. If you're gonna live in the house for 30 years, it definitely makes sense. So builders have a lot of incentives like this right now. Miranda sent me an email the other day, a builder up in Murata. We made that video about Murata and we featured this specific builder. I got an email from them the other day that they have like 5 or 6 inventory homes. A couple of them are finished right now and a couple of them will be finished by the end of the year. And they're offering a $40,000 flex cash. What a buyer could do with that flex cash is they could buy their rate down, or they could just apply it to their closing costs so they have less cash out of pocket, or they could just reduce the purchase price. That's gonna have the least amount of impact on your like cash out of pocket within the next 5 years. But you could use that in all kinds of ways, and this is just a very common incentive that builders do whenever the market's like this, whenever it's a little bit slower, whenever they don't have people just knocking on their door. They've also dramatically increased the commission that they're paying realtors. So previously, if I would have brought Miranda a client and they built a house, they would pay me $7,500, just a flat fee, and say it's a $600,000 house. Now, they're paying a 4% commission. On that same $600,000 house, my commission went from $7,500 to $24,000. That's a big change. In general, most people move within 5 years. When they buy a house, within 5 years, they sell it and buy another one. So maybe it just makes sense to have a little bit higher payment for a little while, even if it was for 5 years. I'm talking about my own payment as well. I'm talking about my own situation, not just yours. So I don't just want to say it's a good idea for you to have a higher payment. I'm actually in the middle of this too, and just trying to decide what's best. There's other ways that mortgage companies try to reduce your payment that I don't really like longer mortgages, 40-year mortgages, or they have some like interest-only mortgages for the first 10 years and then like another 30 years is tacked on after that 10 years. I don't like that kind of stuff. It feels shady, but maybe that's where the mortgage industry is going. Car loans used to be a lot shorter. Now they're, 6-7 years at times. So to make that monthly payment shorter. And, with a house, it's gonna last way more than 40 years. So it might make sense that the industry is going to move that direction to reduce monthly payments, but then you're just tied up with the bank even longer, which I don't love. If you want to talk through any of these scenarios, we would love to help you out. We are a team of realtors here in the area. We would love the opportunity to work with you. Please give us a call, text, email anytime, and thanks for coming by.